Opening a brokerage account, funding the account, researching and buying stocks are key steps in the investment process. But you don't stop there. After buying stocks, what do? You don't go to sleep. It's very important you effectively monitor your investment portfolio. It's very important when it comes to the overall success of your investment journey. So portfolio monitoring is the ongoing process of tracking and evaluating the performance of your investments to ensure that they align with your financial goal, your risk tolerance, and market conditions. It helps you identify any investments that may be needed to maintain your desired asset allocation and optimize returns. So we want to highlight key components of portfolio monitoring. Key components of portfolio monitoring. Number one is performance tracking. Performance tracking. It's necessary you regularly, assess how individual assets and the overall portfolio are performing, relative to the benchmark or your return objectives. This includes checking the growth or decline of individual stocks in the value, in the portfolio, and to also determine the overall performance of the portfolio. Number three is asset allocation. Asset allocation. So in this case, you ensure that the portfolio remains diversified and that the distribution of assets, it could be bonds, it could be stocks, it could be real estate, commodities, even cash, aligns with your target allocation, because you should have a percentage allocation to each of these asset classes. And so do they say align with your target allocation? Number three is risk management. Risk management. So in this case, monitoring the risk profile of the portfolio becomes very important because it may change due to shift in market conditions, asset performance, or changes in your financial situation. Number four is the market conditions. So you need to keep up to date, become highly updated when it comes to economic factors like interest rates, like unemployment and figure, inflation, and other relevant factors. And not only that, you consider global events that might impact your investments either positively or negatively. It could be tariffs, it could be trade war, and any other and other relevant factors. Number five is a reinvestment of earnings. You ensure that some dividends or interest payments are reinvested properly, to maximize compounding over time. In this case, you may adopt dividend reinvestment plan. As you get your dividends, the amounts involved is automatically reinvested into this company to encourage compounding over time. Number six is goal progress. You regularly check if the portfolio is on track to meet your long-term investment objectives or financial goals, such as it could be retirement savings, it could be buying, either a car or property or funding your children education, whatever the goal may be. You track the portfolio to ensure that it aligns with these goals. So why portfolio monitoring is important? Why is it important or significant to monitor your portfolio? Number one is identify underperforming assets. When you monitor your portfolio, you'll be able to identify assets that are not performing, you know, when it comes to your objectives. So you identify underperforming assets. So in that case, you may need to review, you may need to sell underperforming assets in your portfolio. Number two is adapting to changes. Adapting to changes. Your financial goals or risk tolerance may evolve. So it's important to adjust your portfolio accordingly. If you suddenly become, highly risk averse, you need to review your portfolio and rebalance your portfolio. You have a larger portion in bonds and less in equity. Number three is responding to market volatility. Responding to market volatility. Portfolio monitoring allows you to stay alert to market fluctuations and make necessary adjustments during periods of market stress or economic changes. When you monitor your portfolio, you detect when it becomes necessary for you to align your portfolio with as it relates to volatility, how you respond to volatility in the markets. Number four is tax efficiency. By regularly monitoring your portfolio, you can take advantage of tax savings strategies like tax loss harvesting to optimize returns. You sell underperforming assets to avoid taxes. That is a good strategy. Number five is maintain diversification. So over time, certain assets may grow faster than others, leading to a kind of overexposure to a particular sector or asset class. So monitoring could help you to rebalance the portfolio accordingly. If you have too much percentage of your fund in a particular asset class, you may need to trim it and redeploy it elsewhere so as to maintain adequate diversification. So best practices for monitoring your portfolio. Best practices for portfolio monitoring. Number one is a regular check-in. You make it a habit of regularly checking your portfolio. In as much as you don't get obsessed with the portfolio, but it's necessary you monitor it regularly. It might be quarterly, at least quarterly. Number two is stay objective. Don't make decisions based on emotions. Be logical. Remain, objective. Focus on your long-term goals. Number three is avoid over-adjustment. This adjustment, which is healthy, there is over-adjustment, which is unhealthy. So constantly tweaking your portfolio to respond to short-term fluctuations can be detrimental. It's not good. All right. So stick to a long-term plan and only adjust if there's fundamental changes in your financial goals or market condition. And that could be done probably quarterly, every quarter, instead of doing it every week. You are tweaking your portfolio because you cannot stay disciplined. You have that particular itch to click a sell or a buy button. It ought not to be so. Please like this video and subscribe to this channel if you've not done that. Number five is review risk exposure. Review risk exposure. Ensure your portfolios and risk level remains consistent with your goal. As you approach retirement, for example, you may want to reduce your exposure to riskier assets. You may want to concentrate more in bonds than in equities. Bonds and other interest-bearing, asset classes like money market investments. Number five, track expenses. Keep an eye on any expenses or costs associated with your investments because it can be high at times. I think you consider the fees you incur here and there, you'll be surprised of how much goes in as transaction cost, which could erode returns over time. So by regularly monitoring your portfolio, you can stay aligned with your financial objectives and adapt to changes in the markets or your personal changes in your personal situation.